Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine you're strolling down Wall Street, dressed in your finest pajamas, looking up at the massive skyline of stocks, bonds, and that elusive notion of financial freedom. The question swirling around your head: should you dive into the market and stay there for the long haul, or should you try to outsmart everyone by jumping in and out at just the right moments? Let's explore the subtle yet powerful difference between time in the market and timing the market, and why it might just save you from a few sleepless nights. Before diving deeper, picture a person who's convinced they can predict exactly when the market will peak and when it'll crash. They do hours of research, consult crystal balls or YouTube gurus, and turn into a ball of stress each time a new economic statistic comes out. This is timing the market in a nutshell. Now imagine a different scenario. An investor calmly adds money to their portfolio month after month, year after year, seldom bothering to check short-term price swings, much like planting seeds in a garden and letting them grow through the seasons. That's time in the market. The fundamental difference? One approach tries to outsmart everyone else day by day, while the other uses the tremendous advantage of long-term growth and compound interest. On paper, time in the market sounds almost too easy. Buy, hold, wait, keep waiting, and watch your investment, hopefully, grow like a well-watered plant. The trick is that markets, over the long term, tend to rise despite the occasional meltdown, crash, or bizarre moment of mania. Historically, major markets like the S and AMP Wink with Tongue Sticking Out 500 have moved upward, even if they've taken a roller coaster path to get there. And the reason some people find this so compelling is the concept of compounding. By reinvesting gains and dividends, each little growth spurt sets the stage for even more growth in the future. You let time do its magic while you ideally do something more productive than endlessly refreshing your brokerage account. Now, let's flip the coin and explore timing the market. It's the idea that you can dodge the bullet whenever the market is set to tumble and then jump back in just as everything's about to skyrocket. The allure is obvious. Why watch your portfolio drop by 30% when you could have sold everything 1 week earlier, right? But the harsh reality is that predicting these turning points with any consistency is notoriously difficult. Some might argue it's impossible for the average investor. Even seasoned professionals who spend their lives studying the markets can have a pretty rough time nailing the highs and lows. There's a long trail of historical examples illustrating how challenging timing can be. Consider the dot-com bubble of the late 1990s. Plenty of so-called experts were sure they could see the top coming. Some sold too early and missed further gains. Others sold too late and got clobbered. Then there's the financial crisis of 2008. People who moved all their money to cash before the crash might look like geniuses for a moment, until they failed to jump back in at the right time and miss the recovery. The sad part? Missing even a handful of the market's best performing days can drastically reduce your overall returns. Studies show that if you take the top 10 or 20 best days out of a span of many years, the returns of the market can shrink dramatically. Timing the market too often leads to missing those critical days. This is where compounding becomes a true superhero for the long-term investor. Imagine you have a modest sum invested in a diversified portfolio that yields, let's say, an average annual return of 7% over a few decades. If you just keep that money there, reinvest your gains, and add consistently, the snowball effect can be huge. Each year's growth helps feed the next year's growth, and so on. Now toss in dividends, and it's like adding a little extra fertilizer to your financial garden. Sure, the market has dips, some of them quite scary, but historically it has always bounced back, at least so far. That's the key advantage of time in the market. Of course, none of this is purely mechanical. We have to talk about investor psychology and how emotions can sabotage even the best laid plans. It's easy to say you'll just buy and hold, but when the market is in free fall, it feels like the floor is falling out from under you. Fear creeps in, panic sets up camp, and suddenly you're thinking, should I sell everything now? Is this the end of capitalism as we know it? Conversely, when the market is sky high, greed comes knocking. Maybe I should load up on more shares right now because everything's going up forever. These emotional extremes, fear and greed, are the nemesis of rational long term investing. That's why many people fall into the trap of trying to time the market. Emotions push them to make moves that feel safe in the moment, but can be disastrous in the long run. If your aim is to avoid the emotional roller coaster, several long term strategies might help. First, there's dollar cost averaging, DCA, the practice of investing a fixed amount of money at regular intervals, regardless of market conditions. This automatically puts you in the habit of buying the dip when prices are lower because your regular contribution buys more shares and avoids the dreaded panic of putting in a lump sum at the wrong time. Then there's diversification, spreading your investments across different sectors, regions, and asset classes to cushion potential shocks. Some might also consider periodic rebalancing, trimming the assets that have gained excessively and adding to those that have dipped below a target allocation. These strategies aim to remove as much emotion from the process as possible. Now let's examine a few risks if you're set on timing the market. First, transaction costs and taxes can become a huge burden. Every time you buy or sell, you potentially trigger fees or capital gains taxes. Even if your timing was only partially correct, these extra costs can eat into whatever profit you manage to eke out. Then there's the risk of sitting on cash for too long. While you wait on the sidelines for the perfect entry point, the market might be steadily climbing. Once you finally muster the courage to jump in, you've already missed significant gains. That's not exactly a recipe for investment success. Let's not overlook that there are times when it might actually make sense to hold more cash or be more cautious. If you know you'll need a certain amount of money in the near future, for example, to pay for a house down payment, a wedding, or a spontaneous trip to space if that's your dream, then you certainly shouldn't park all of that money in volatile assets and cross your fingers. Also, if you spot some clear macroeconomic risks and you have serious reasons, not just rumors on social media, to believe a downturn is imminent, it's not insane to shift to a more conservative mix. Still, the keyword is conservative mix, not panic selling everything and burying gold bars in your backyard. The general idea is to balance your need for liquidity, your risk tolerance, and your long-term goals. Too many people confuse legitimate caution with perpetual market timing. Putting it all together, the overarching theme is that most of us stand to benefit more from staying invested than from obsessively trying to hop in and out of the market. The data repeatedly shows that missing just a handful of the best market days can drastically shrink your returns, and no crystal ball exists to reliably inform you which days those will be. A disciplined plan that embraces time in the market tends to deliver better results for the vast majority of investors. As dull as it might sound, letting your money grow gradually, while resisting the urge to panic or chase hot tips, is one of the surest ways to build wealth over the long run. Now, to address a few common questions and myths that often pop up. Some wonder if they should wait for a dip to start investing. The idea is, stocks are too expensive right now, I'll wait until they drop 10 or 20%. The awkward truth is that nobody knows when that drop will come, if at all, or how quickly it will bounce back. By the time you're sure the market is dipping, it might have already bounced. Another myth is that only experts can succeed with a long-term approach. But the beauty of index funds, ETFs, and basic asset allocation is that you don't need to be a financial wizard. You simply need to follow time-tested principles consistently, even when it feels scary or counterintuitive. And let's not forget the myth that the market is rigged. While there are certainly bad actors and complexities in financial markets, it's an overstatement to suggest the entire system is out to get you. Over long periods, broad market participation has historically allowed everyday investors to share in overall economic growth. Of course, none of this is to say that focusing on time in the market is somehow a foolproof plan to become a millionaire overnight. If that's what you're expecting, you might be better off spending your money on lottery tickets or advanced level courses in telepathy. But for the rest of us, slow and steady tends to win the race. While your friend who claims they can time the market might enjoy a few lucky streaks, luck has a funny way of running out right when you need it most. And if you're the type who loves a bit of adrenaline, Maybe keep a small portion of your portfolio for more speculative plays, just don't bet your retirement on it. This all comes down to deciding which approach best suits your personality and goals. If you genuinely believe you have the discipline, knowledge, and resources to time the market accurately, there's nothing stopping you from trying. But be aware that you're taking on a challenge that confounds even the most seasoned pros. And if you find that the emotional toll or the complexity is too great, don't worry. There's a massive community of long term investors who simply keep adding to their portfolios while ignoring the daily drama on business news channels. They have found a path that not only simplifies their financial life, but often yields solid results over the decades. Ultimately, it's about finding balance. Keep enough cash on hand for emergencies, invest the rest prudently, and resist the urge to jump ship whenever headlines turn scary. Give yourself the best chance to experience the power of compounding over time. Remember, the market's short term wiggles might grab attention, but it's the long term trend that truly builds wealth. And if someone insists they can consistently time the market, maybe politely nod, smile, and suggest they start a fortune telling booth. You'll be far too busy watching your portfolio quietly flourish. That's the essence of how time in the market can often beat timing the market. It's the steady tortoise versus the hyperactive hare. One relies on time and the magic of compounding. The other banks on outsmarting everyone else. Not that it can't be done, but the odds aren't pretty. When in doubt, remember the phrase, time in the market beats timing the market. Let it be your shield against impulsive decisions and a roadmap for building a nest egg that lasts.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you and take care of yourself and your finances.